What is an S-Corp? Choosing the best business structure. For businesses that meet the criteria, opting for S-Corp status can lead to significant tax advantages. When people casually mention a corporation, they often refer to the most familiar type, a C-Corp, which pays corporate income tax and has no limit on shareholders. However, the S-Corp designation carries a distinct meaning. In this article, we will delve into the S-Corps, highlighting their characteristics and comparing them to other business structures. If you're considering forming an S-Corp, you can utilize the link provided in the description to open an LLC with Zen Business. Understanding S-Corps. Defining a corporation. A corporation is a legal entity established by filling in corporation documents at a state level. Corporations differ from sole proprietorships, partnerships, or LLC in various ways. A corporation comprises shareholders, directors, and officers. Shareholders own company stock. Directors establish policies and oversee the broader strategy, while officers manage the day-to-day operation. Small businesses, a single individual might fulfill multiple roles. As a separate legal entity, a corporation shields shareholders from the corporation's debts. Corporations are subject to specific legal obligations, including regular meetings and maintaining corporate records. An S-Corp, while a form of business entity like a corporation, is a tax designation available to specific corporation and LLCs. S-Corps are named after the subchapter of the Internal Revenue Code that outlines its tax classification. The most distinctive feature of an S-Corp is its pass-through tax structure. According to the IRS, S-Corps pass corporate income, losses, deductions, and credits through to shareholders for federal tax purposes. Essentially, S-Corps are exempt from federal corporate income tax. Instead, dividends are taxed at the individual level. Subject to the applicable marginal income tax rate, the structure allows shareholders who meet specific criteria to offset corporate losses against income from other sources on personal tax return. In contrast, C-Corp shareholders cannot deduct corporate losses from other income on personal tax returns. While shareholders still pay personal income on dividends, this occurs only after the entire corporation's gains have been taxed at a corporate income tax. This double taxation has historically been accepted as a trade-off of a corporation's liability protection. Alongside tax benefits, X-Corps enjoy the same liability protection offered by corporation status. Additionally, S-Corps maintain independence from an owner. This means that the departure of key shareholders does not significantly impact the company's longevity, as it might not cooperate business structure. This flexibility also extends to transferring ownership, either through an outright sale or a gradual transition. However, many S-Corps have transfer restrictions that make it more challenging for shareholders to exit compared to C-Corps. S-Corp taxation isn't exclusive to corporation. Eligible LLCs can also opt for S-Corp taxation. By default, LLCs are taxed like sole proprietorships or partnerships, with owner considered self-employed and subject to self-employment tax on all business profits. In contrast, S-Corp shareholders can be classified as company employees, reporting both salary and distribution from company profits. While S-Corp shareholders pay self-employment tax on salary income, distribution income is not subject to such taxes. Given the benefits, one might wonder why not all businesses choose S-Corp status. There are various stipulations for operating as an S-Corp, which could disqualify or discourage businesses seeking these advantages. Notably, strict limits apply to shareholders. S-corporations cannot exceed 100 shareholders, effectively preventing corporations aiming to go public. S-Corp ownership is mainly restricted to individuals, who also must be US citizens or permanent residents, as well as specific domestic trusts, estates, and tax-exempt organizations. This disqualifies ownership by other corporations or partnerships, which can typically purchase a stock in the C-Corp. S-Corps may face additional IRS scrutiny, especially concerning the allocation of income between salary and dividends. Salaries paid to S-Corp shareholders must be reasonable and not artificially low to evade taxes. While seeking advice from licensed tax and legal professionals is crucial, an overview of pros and cons can provide valuable guidance for businesses. S-Corp's advantages. Pass-through taxation prevents the double taxation experienced by C-Corps. Corporate losses can often be passed through to owners. Limited liability for directors, officers, and shareholders. Independent existence from shareholders. Annual tax filling instead of quarterly. Potential for lower self-employment tax for LLC owners. Disadvantages. Maximum limit of 100 shareholders. Stringent shareholder requirements allowing only US citizens, permanent residents, specific domestic trust, estates, and tax-exempt organizations to hold stock. Restriction to a single class of stock. More challenging to raise equity financing corporate to C-Corps. And increased IRS scrutiny, especially concerning the balance between salary payment and dividends. Although S-Corps possess attractive attributes, they represent just one amongst various possible business structures designations. Ultimately, the appropriate choice depends on a business' unique circumstance. Here are some other common options to consider. C-Corp. They are the prevalent form of an corporation that share similarities with S-Corps. The distinctions lie primarily in federal taxation. Unlike S-Corps, C-Corps experience double taxation, paying corporate income tax initially, followed by personal income tax at the individual level for dividend gains. However, C-Corps can have an unlimited number of shareholders and include both domestic and international entities. LLC. This is a limited liability company, combines the ease of partnership structures with enhanced risk protection and tax benefits akin to corporations. LLC owners aren't personally accountable for business obligations, while members are typically taxed taxed like owners of sole proprietorships or general partnerships. An LLC can also choose to be taxed as an S-Corp or a C-Corp under certain conditions. Sole proprietorship. For circumstances where legal separations between businesses and owners is unnecessary, a sole proprietorship might suffice. This structure offers simplicity and control, but the owner remains liable for business, legal, and financial issues. Partnerships share similarities with sole proprietorships in terms of liability and taxes. Partners report their share of income, expenses, and profits on personal tax returns, paying personal income tax rates and assuming personal liability for the business. There isn't a one-fit-all solution when it comes to business structures and tax treatment. The right choice depends on the unique context of each business. Consultation with legal and tax experts during the formal process is crucial.